How to reduce the frequency of checking prices. A behavioral finance perspective. Constantly checking prices feels productive. It feels like control. But research in behavioral finance suggests the opposite. The more frequently investors check prices, the more likely they are to make emotionally driven decisions that hurt long-term returns. This phenomenon is closely related to what economists call myopic loss aversion, introduced by Shlomo Benartzi and Richard Thaler. 1. Understand the psychological mechanism. Myopic loss aversion. When you look at your portfolio frequently, you see more short-term losses. Losses feel about 2x more painful than gains. Loss aversion. You become more risk-averse. You are more likely to sell prematurely. Research shows that investors who receive frequent feedback take less risk and earn lower long-term returns compared to those who view results less often. In short, the more often you look, the more volatility you feel. 2. The dopamine loop, why it becomes a habit. Frequent price checking resembles social media refresh behavior. Uncertainty check price. Small move emotional reaction. Brain receives dopamine hit. Habit strengthens. Over time, this becomes a compulsion, not strategy. 3. Evidence from long-term investors. Disciplined investors influenced by the philosophy of Warren Buffett focus on business value, not daily price movement. Buffett famously said, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes." This mindset structurally reduces the need for frequent monitoring. Practical strategies to reduce price checking. 1. Pre-commitment rule. Create a written rule. I check my portfolio only once per month. Or, I review only on the first Sunday of each month. Pre-commitment reduces impulsive behavior. 2. Remove frictionless access. Delete brokerage apps from your phone. Log out after each session. Turn off price notifications. Use a separate device only for scheduled reviews. Behavioral design works better than willpower. 3. Shift the question. Instead of asking, "What happened today?" ask, "Has my long-term thesis changed?" If the answer is no, no action is required. 4. Automate investments. Automatic investing reduces the psychological urge to manage constantly. This is consistent with passive investing frameworks popularized by index fund pioneers like John C. Bogle. Automation decreases emotional interference. 5. Increase the evaluation interval. Studies show that when investors evaluate performance, daily high stress, low risk tolerance, monthly moderate reaction, yearly more rational decisions, longer intervals reduce perceived volatility. 6. Track process, not price. Create a checklist. Am I saving consistently? Am I diversified? Are costs low? Am I following my plan? This shifts focus from outcome to discipline. 7. Replace the habit. Every habit needs a substitute. Instead of opening your brokerage app, read one page of an investing book. Journal your long-term goals. Review your asset allocation. You are not removing the impulse, you are redirecting it. The hidden cost of frequent checking. Frequent price monitoring causes higher trading frequency, emotional decision-making, increased stress, lower long-term returns. Paradoxically, the investor who does less often earns more.